Hello, my good students. I hope we are all okay. Welcome back to our session today. After the last session where we had introduced the concept of issuing of shares, more so our specific area of concentration was on the rights issue. So I think we are very familiar with the main concepts that we must always tend to have at the back of our mind. So therefore that should take us straight to the question here that I want us to handle. Remember we had already analyzed this question in the previous class. So basically, this is what you are required to do, believing that you can all see this question of ours here. Is a question that we had analyzed in the previous session. So you can also still analyze it and we work it out then quickly. So these are what you are told, that HISA Limited has 1 million ordinary shares outstanding at the current market price of 50. So already I'm giving the market price per share. The company requires 8 million to finance a proposed expansion project. So that is to say that there is a new project that is coming and I have to finance it, and the cost of financing this project is 8 million. The board of directors has decided to make 1-for-5 rights issue at a subscription price of 40 per share. So I'm giving the offer price of this rights issue that you need to make. For every 1-for-5, we'll have to, of course, that is a proportion of the shares that each person will be holding. So we need to make, of course, a figure. We need the offer price will be 40 per share. The expansion project is expected to increase the firm's annual cash inflow by 945,000. So that is to say that the annual cash inflow of the firm, that is, of course, it is expected to increase by 945,000. Whenever we've seen any form of cash flow, of course, the concept of discounting should always come into our mind. Then you also told that information on this project will be released to the market together with the announcement of the rights issue. So here we are required to, the company paid a dividend of 4.5 in the previous financial year. That is the dividends that we paid. The dividends together with the company's earnings is expected to grow by 5% annually. After investing in the expansion project, okay, required, the first thing that the examiner wants us to compute is the price of the shares after the commencement of the rights issue, but before they start selling at X-Rite. So simply what the examiner wants us to do is to determine the cum-right price, that is of course the talk of the price that our shares were selling before this rights issue, the cum-right price. That is what exactly what the examiner wants us to determine. And therefore, in that case, we also told that to compute the theoretical X-Rite price of the shares, remember these are the concepts that we had looked at, compute the theoretical value of the rights when the shares are selling rights on. Then also, I'm also required here to determine what would be the cum-right price per share if the new funds are used to redeem 8 million 10% debentures at par. Assume that the corporation, assume a corporation tax rate of 30%. Of course, that will bring us to the concept of tax shield. So, given that question, you can squeeze it down here and see what we'll be having, believing that once squeezed here, it will still be visible. So the first thing that the examiner wants us to determine here, we've seen clearly that this good examiner wants us to determine the cum-right price, okay? And for us to determine the cum-right price, you must always recall this case, that for me to determine the cum-right price that our shares were selling just before the rights issue, this case we are talking of course, our current market price of the shares, market value of the shares, we are going to add the net present value per share. We're going to add the net present value per share. That is what you are given. And clearly, I can see that our good examiner already had given us the market value, the current market value of the shares. You're told that they were trading at how much? The current market price of the share. We can clearly see that our good examiner has given us the current market price of the share, which is 50. Our shares were trading at 50. Therefore, what about the NPV per share? So remember, for us to determine NPV, if you can always recall, for us to determine NPV, we normally tend to talk of what? The present value of the cash inflows, present value of the cash inflows, present value of the cash inflows, minus what? Our initial investment, or in this case, cost. Initial investment or our cost. And for us to determine the NPV per share, therefore, I must have what? NPV, net present value of our cash flows, we divide by the number of shares. This will give us the NPV per share. That will give us our NPV per share. So breaking it down, let us see what we'll be having. Do you have the present value of the cash inflows? Yes, we are told that our cash will, this project will generate an annual cash flow, an increase in annual cash flow of how much? 945,000. So whenever I've seen that, and in this case, remember, we weren't given any number of years or so, so therefore that should take us to this other concept of determining the present value, where we normally tend to talk of our cash flow. We are going to divide by our cost of equity. Cash flow we divide by our cost of equity. The amount that I'm having, we divide by our cost of equity. So cash flow we are given, yes, we should be talking of 945,000. And therefore, at this point, my good students, we should be able to determine our cost of equity, because recall, the examiner didn't give us our cost of equity. So the good question that I'm going to ask you, my good students, is, do you still recall how to determine cost of equity? Remember, these are some of the items that we had looked at earlier on. Do you still recall how to determine the cost of equity? Of course, the determination of cost of equity is something that should always be at the back of our mind, where we normally tend to talk of what? KE. Recall, KE. We normally tend to talk of our KE, taking our D1 of our market, talk of our D1, of course, of our PO, that is PO, market value, minus any flotation cost that we'll be having, or any discount. I should not forget to multiply by G. And right now, I know, my good students, we know very well that the same case is as if we are saying D1 is the same as, say, we are talking of DO, 1 plus G, of course, into PO minus F minus discount times what? Times G. That is something that we must always tend to have at our fingertips. This concept of, remember where we looked at our cost of capital, right? This is very key. Also at this point, this is very, very key. Okay. Once we have that, let us determine our cost of equity, my good students. So cost of equity here, we can agree and say that my cost of equity, we should be having our D1. And our D1 in this context, I'm told we had the current dividends, or rather the dividends that we just paid, which I'm told that we paid a dividends of how much? Look at the second last paragraph. The expansion project is expected, no, that one, actually the last note. The company paid a dividends of 4.5 in the previous year. So you can agree and say that this is our 4.5 previous year into 1 plus growth rate. In this case, growth rate, we are told that the company expects to have a growth rate of 5%, 0.05. All this you are going to divide by what was our market value, PO. In this case, I'm having 50, and we didn't have any flotation or discount. Then we multiply by we add by our growth rate, not multiplying, but sorry, this one is add, right? We add. This one we add. We add by our growth rate. We add by our growth rate, which is 0.05. My tongue probably had said add, then I've written multiplication, right? So basically that is plus G. Sorry. So therefore, once we have this, what can we have? Of course, we should be talking of, let me pick my calc. Where is the calc? So we're going to talk of 1.05 times 4.5 divided by 50 plus 0.05. In this case, I'm getting my KE. I'm getting it to be 14.45%, right? Once we have our cost of equity, that will be simple because the other element that I need to do is there to determine my present value. And to determine our present value, we are given the cash flow. What were we given as our cash flows? The cash flows we are given annual cash flow of 945,000. We divide by our KE, which we determine our KE to be 14.5%, 0.1445, right? So that should give us what? This should give us 945,000 divided by answer. I'm getting 6 million. So my present value of our cash flow, 6,539,792, right? Present value. So once you have our present value at that point, recall my main aim is to determine our NPV. So my NPV, therefore, we should be talking of how much? Our NPV, we should be talking of our present value, which is 6 million, 539,792. We less what? What is the expected outflow? How much do I need to invest? In that case, you're told that we needed to invest how much? 8 million, right? The company requires 8 million. That is what we needed to invest. So I'm having minus 8 million here. So you're talking of 8 million. So therefore, we can agree and say that our NPV, I should be having minus 1, 2. I'm having an NPV of minus 1460, 208. So definitely these are negative NPV, right? Which clearly shows not desirable. Therefore, after we have determined that, I don't know why I'm used to this therefore nowadays a lot. NPV per share, we should be talking of the NPV that we determine minus 1460, 208, right? Recall this. We divide by the number of shares. How many shares were we intending to raise? The number of shares according to our question, the one that we're intending to raise, we were intending to raise 1 million ordinary shares. So divide by 1 million here. Divide by 1 million. So therefore, we can agree that NPV per share, we should be talking of divide by 1 million. I should be having a figure of negative 1.4602, which is just the same as saying negative 1.5. Now, look at our cum-rights price, which we had written there earlier on. Cum-rights price, for us to determine our cum-rights price, I should be talking of my cum-rights price will be cum-rights price. We are talking, of course, of the current market price per share, which is 50. I'm going to add by the NPV per share, which in this case we determine our NPV per share to be minus 1.5. So therefore, what will we be having as our cum-rights price? I should be talking of 50 minus 1.5. 50 minus 1.5 to give us a figure of how much? 48.5. 48.5. So that would be our cum-rights price, 48.5. The prices that our shares were selling just before the aspect of before the right issue. So that is what you should be having. I believe that is very clear. We proceed to the second question here. Second question. I believe that this question is visible, my good students. So second question, these are what you are asked. Compute the theoretical extract price of the shares. Theoretical extract price of the shares. Theoretical extract price of the shares. And I believe by what we saw the other time, in this case, that will be easy. Right? Because extract price, we said, I'm required to compute our theoretical extract price here. So number 2, the examiner wants us to compute theoretical extract price. Theoretical extract price, which to compute theoretical extract price, you can recall, I should be talking, of course, of the number of, this is a number of existing shares. We multiply by, of course, the, that is, of course, the market price per share. We are going, of course, this case to add our new shares times the offer price. We divide by the existing shares, right? We divide by our existing shares. So therefore, what will we be having here? We are talking, of course, of the theoretical extract price. I'm talking of number of existing shares, number of existing shares. We're going to multiply this one, of course, by what we are referring to as market price per share. We add, believing that that is visible, we add the new shares, that is, of course, number of new shares, we multiply by the offer price. We are going to divide all this. Remember, this is summation. We are going to divide all this by what? By the number of existing shares. We add number of the new shares, number of new shares. Basically, that is how we can determine our theoretical extract price. So, having mentioned that, I think we can proceed and determine it. Our theoretical extract price here. So therefore, my theoretical extract price, which refer to it as a PX, number of existing shares. How many shares did we have? Let us check our question here. Number of existing shares. So number of existing shares, you can clearly see that we were given a number of existing shares. I'm looking at that note so that you can just go through it directly. So 1 million shares actually is what we needed to raise, right? HISA Limited has 1 million ordinary shares outstanding. That is what we are having right now at the market price of 50 shares. So in that case, you can agree that I'll be having what? I'll be having, of course, 1 million existing shares. So that is my existing shares is 1 million. 1 million. Okay. We multiply by the market price, which was 50. Correct. We are going to add number of the new shares. What will be the number of the new shares? In this case, we are told that the board of directors has decided. The board of directors has decided to make 1 to 5 rights issue at a subscription fee of 40. So basically, we are talking of 8 million divided by 40. That should give us how many shares? 8 million divided by 40 That should give us 200,000, right? 200,000. So number of the new shares, I'm having 200,000. We multiply by the offer price. Offer price in that case, of course, you are given what? See, it is 40, right? 40. It is 40. So I'll just be multiplying this one by 40. By 40, because that is what you are given, to take us back to the 8 million. Then you are going to divide all this by what? You're going to divide all this by the number of existing shares, which is 1 million. We add number of new shares, which is 200,000. So therefore, what will be our theoretical ex-right price? What will be our theoretical ex-right price in that case? What would be a theoretical ex-right price, my good students? We should be talking, of course, of 1 million times 50 plus 200,000 times 40. We divide here, that is, of course, we divide by 1.2 million. I'm getting 48.33. So in this case, you're having 48.33. We're having 48.33. So that should give us what? Our theoretical ex-right price. That should give us our theoretical ex-right price. Believing that it's flowing, you might see that it's a lot of tasks, but it's very kind of easy, right? So long as you've mastered your formula correct. Let us proceed to the next item. What are we required to do in the next item here? The next item, you're told to compute the theoretical value of the rights when the shares are selling. When the rights shares are selling. Basically, that case, recall, we had looked at that. Where we mentioned that anytime I'm talking of theoretical that is the value of the rights, where we should be having, of course, the market value. In that case, we should be talking, of course, of our market value of the shares. Market value of the shares minus what? The issue price. Minus the issue price. Minus the issue price. Minus the issue price. Minus the issue price. So therefore, in that case, what will we be having? What will we be having? Market price of the shares times the issue price. I think that is easy because you already determined our issue price here, which is a theoretical ex-right, right? Theoretical ex-right price. So I think that will be easy. I think that will be easy because this is what we'll be having. Allow me to erase here. We had looked at that earlier on. So here the examiner wanted us to determine that other part of, that is of course, theoretical value of rights when shares are selling. Theoretical value of shares. Theoretical value of shares. Theoretical value of shares. Theoretical value of shares. Theoretical value of rights. Theoretical value of rights when shares are selling. When shares are selling. That will be simple. That will be simple, my good students, because at this point, whatever that we'll be looking at will only be considering, of course, a market price of our shares minus our ex-right price. Ex-right price. Whereby in this case, market price of the shares, of course, was 50 minus ex-right price, we are determining it to be 48.33, right? 48.33, which basically that should give us how much? 50 minus 48.33, 50 minus 48.33 That should give us 1.67. So you should be having 1.67 theoretical value of the rights when shares are selling. As simple as that. As simple as that. Okay, proceed to the last part of the question. This question is quite okay. Last question. What would be the cum-right price per share if the new funds are used to redeem 8 million 10% debentures at par? So in this case, of course, I'm brought to the concept or to the idea where we need to determine our, if at all, I'm taking debentures. If the debentures are redeemed, not issuing of shares, but if we take debentures. And we're told that what will be the cum-right price per share if the new funds are used to redeem 8 million 8% debentures at par? So basically, in the event that I'm having debentures, in this case, this time round, we need to issue, or rather the cum-right price, compute what will be the cum-right price per share if the new funds are used to redeem 8 million 10% debentures at par. So therefore, that will be easy, because just like the other item that you had looked at first, this is what you're supposed to do. But this time round is debentures, right? So to do that, cum-right price, in the event that you're issuing debentures, cum-right price if debentures are issued, cum-right price if debentures are issued, cum-right price if debentures are issued, cum-right price if debentures are issued. This will be easy, because we should be talking of the cum-right price to be aspect of cum-right price of our shares, cum-right price of our shares, cum-right price of the market value for shares. We should be talking, of course, of the current MPS, current market value of our shares. We are going to less present value interest tax shield. Present value interest tax shield lost. Present value interest tax shield lost. Simply because, remember, at this point, I'm going to enjoy the concept of what? Of that interest tax shield. That interest tax shield is always a component of tax in the interest. A component of tax in the interest. A component of tax in the interest. So what will be our interest tax shield? That's the first thing that we need to do, because already we do have the market price, where in this case our market price won't change. Market price of the shares, you're given 50. So it's upon us to determine the interest tax shield. Interest tax shield. Interest tax shield. We just say that it is just that component of what? Interest times the tax rate. Interest times our tax rate will give us what? Our interest tax shield. So therefore, in our case, what was our interest? We were told that we are going to redeem the debentures, the 8 million, that is what we need to raise, which we are going to redeem the debentures, and these debentures will attract an interest of what? 10%. So what is the tax on that interest? What's the tax on the interest? What's the tax on the interest? We should be talking, of course, now this one I'll be paying 8.3 times 0.10 times 0.3. Clearly you can see my interest tax shield, I'm getting a figure of 240,000. We're getting our interest tax shield of 240,000. Once we have that case, the other key element that you need to determine, of course, is the present value. What will be our present value here? What will be our present value? What will be our present value? What will be our present value? What will be our present value here? So our present value, of course, of the interest tax shield, the same case as we looked at it, I need to erase here. the same case as what we had looked at earlier on. Remember the other time when you started the question, the present value, say that if not given, we'll always be taking, of course, the amount we divide by our cost of equity. So our present value of our interest tax shield, present value of our interest tax shield, we're going to take our amount of interest. So therefore I'm having the interest tax shield. We're going to divide by our cost of equity, where interest tax shield we've seen is 240,000. What about our KE? KE we had it to be 0.445, 14.45%, the one that we had computed earlier on, right? Recall the one that we had computed earlier on. So therefore, in this case, we can agree and say that therefore, I should be talking of I should be talking of 240,000 divided by that. I'm having 240,000 divided by 0.1445. I'm getting a figure of 1660, 1650, 900, 1660, 900, 1660, 1660, 1660, 900, 1660, 900, 1660, 900. That is what we're having. Therefore, once we have that case, my good students, what will be our aspect of this is, of course, our present value, right? So it is our NPV. NPV, of course, therefore, it should be having 1660, 900. We divide by the initial cost that I need to raise of 8 million. So therefore, we should be talking of what? 1660, 900 minus 8 million. I'm getting a figure of minus 8 million. So in this case, I'm getting a figure, of course, of 6.3, right? So therefore, we are talking of 240. I'm having 1660, 900, right? We're having 1660, 900. So therefore, this is what we have here, 1660, 900. Sorry for this, 1660, 900, right? So see, that is our present value of our interest tax shield, right? So once we have that case, therefore we need to determine our present value of our tax shield lost per share. Present value for tax shield lost per share. Present value for tax shield lost per share. So I should be talking of our present value for tax shield lost per share. Present value of tax shield, because this is what we're having. Present value of interest tax shield lost, right? So present value of tax shield, present value of tax shield lost per share. I'm having our present value, which is 16,900. Of course, you are going to divide by the number of shares, which number of shares we had, what? 1 million. So basically that should give us what? That should give us 1660, 900. We divide by 1 million to give us 1.67, which is basically aspect of 1.67, right? 1.67, or we can term it as 1.70, right? So once we have that, that will be easy, because then I'll be having our, don't worry, Mwalimu is tired, right? So we're talking of cum-rights price, I'm having 50 minus 1.70 to give us 50 minus 1.70, that should give us 48.3. 48.3. So that is what we should be having there. So that question, that is what you're required to do. That is what you're required to do in that question of ours. So I want us to meet in the next session whereby we're going to handle another question. To that point, guys, thank you so much.